Good day everyone. Today we will continue our discussion about income taxation, particularly deductions. From our previous lessons, we have talked about the revenue or the gross income of a taxpayer. Before arriving at the taxable income of a taxpayer, we need to consider what we call allowable deductions. Especially when a taxpayer is engaged in trade or business, we need to consider its business expenses. But first, we need to differentiate between deductions and exclusions. Exclusions are receipts that are omitted from gross income because of specific statutory or administrative provisions. In general, they are not recognized for tax purposes. So exclusions are those items of income that are not recognized, that is not reported on the tax return. Example is return of life insurance premiums. On the other hand, deductions represent expenditures. These are items that are recognized and subtracted on the tax return. Example of these are rent expenses and interest expense. All forms of realized income must be included in gross income for income tax purposes unless explicitly excluded by law. So no expenditures are deductible from the gross income unless authorized by law. Deductions from gross income, as discussed in this lesson, apply to individuals and corporations engaged in trade or business, and to individuals in the exercise of profession. In this video, we will discuss the first 5 items of the itemized deduction. In place of itemized deduction, resident citizens, non-resident citizens, resident alien, and taxable estates and trusts may deduct a standard deduction in an amount not exceeding 40% of their gross sales or gross receipts. Domestic and resident foreign corporations may also elect a 40% OSD of its gross income. Business expenses, in general, are all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on or which are directly attributable to the development, management, operation, and or conduct of the trade, business, or the exercise of a profession are deductible. Take note that for an expense to be allowed, the reasonableness of the amount being claimed is a prime consideration. Payments, which constitute bribes, kickbacks, and others of similar nature, shall not be allowed as deduction from gross income. An expense may either be treated as capital expenditure or a revenue expenditure. Revenue expenditure is deducted outright as an expense in the year it was incurred from the gross income. The capital expenditure is capitalized and treated as asset. Business expenses allowed as deductions include the following. Compensation payments. Compensation payments must be for personal services actually rendered by employees under an employer-employee relationship. Fringe benefits. The gross of monetary value of fringe benefit furnished or granted by the employer to the employee is deductible provided that the final tax has been paid. Travel expenses. Here and abroad while away from home in pursuit of a trade, business, or profession. Rentals, these are rental payments. Leasehold improvements by a lessee shall be treated as capital investment and not deductible as business expense. In order to return to such taxpayer his investment of capital, an annual deduction for depreciation may be made from gross income for an amount equal to the cost of such improvement divided by the number of years remaining of the term of lease. We will have a separate video on entertainment, amusement, and recreation expenses. It is normal when you borrow money, you also pay interest. Allowed lang ito sa mga taxpayer na engage in trade, business, or in the exercise of profession. But the employees na merong binabayarang interest are not allowed to claim interest expense as deduction. These are the requisites for deductibility of interest expense. May mga negosyante na nag-a-avail ng loan from financing institutions. Same loan na in-avail nila ay ini-invest nila to another financing institution that earns interest. Let us assume that the loan incurred interest expense of 100,000. At the same time, the same loan na in-invest ay nag-earn ng interest income na 100,000. If you will notice, the interest expense, since allowable siya as deduction, will have a tax savings of 30% or 30,000. And yung interest income, since ang interest income ay subject sa final tax, ay meron siyang tax na 20,000, which is 20% of 100,000. And if you will notice, because of the scheme, ay yung taxpayer ay nagkaroon ng savings na 10,000. Dahil sa scheme na yan, nilagyan ng limitation ang deductibility of interest expense, which is decreased by the 33% of the interest income beginning January 1, 2009. Because of the limitation, take note of the interest expense, it is decreased by the 33% of interest income. Because of that, halos wala ka ng tax savings. Let's have a case on interest expense. On January 25, 2020, Alden Company, a depositor of Main Bank, obtained a loan from Arjo Financing Corporation to operate its business. For the year 2020, interest income from Alden's company's deposit with Main Bank is 200,000, on which a final tax of 40,000 was withheld. Its interest expense on the loan obtained from Arjo Financing is 250,000. The question is, how much is the deductible interest expense? So interest expense is 250,000 less 33% of interest income, which is 200,000. That is 66,000. So the deductible interest expense is 184,000. There are taxes that are deductible from gross income, and these are taxes proper only. As a general rule, all taxes, national or local, paid or incurred within the taxable year in connection with the taxpayer's trade, business, or profession are deductible from gross income. Interests and penalties incident to tax delinquency are not deductible from gross income. The following are taxes not deductible from gross income. First is the Philippine income tax. The second is income taxes imposed by authority of any foreign country. But in the case a taxpayer does not signify in his return his desire to avail of the foreign tax credit, this may be deductible from gross income. Estate and donors taxes, and taxes assessed against local benefits of a kind tending to increase the value of the property assessed. Taxes when refunded or credited shall be included as part of the gross income of the year of receipt to the extent of the income tax benefit of said deduction. In the case of a non-resident alien, individual, and a resident foreign corporation, both engaged in trade or business in the Philippines, deduction is allowed only if and to the extent that they are connected with income from sources within the Philippines. If the non-resident alien and foreign corporations are not engaged in trade or business in the Philippines, the rates of income tax are to be based on their gross income. Losses of property arising from fire, storms, shipwreck, other casualties, robbery, theft, or embezzlement, and other losses, if incurred in connection with trade, business, or profession actually sustained during the taxable year and not compensated for by insurance or other forms of indemnity, shall be allowed as deduction. Losses to be allowed as deduction, the taxpayer is required to submit a declaration of loss sustained from casualty, robbery, theft, or embezzlement during the taxable year, not less than 30 days nor more than 90 days from the date of discovery of such loss. No loss shall be allowed as deduction if at the time of the filing of the return, such loss has been claimed as a deduction for estate tax purposes in the estate tax return. In a taxable year, a taxpayer constructed a building for business use which cost him 4 million. Improvements were made on the building and an additional 1.5 million was spent. Unfortunately, the building was totally razed by fire. At this point, the building had been depreciated for 2,500,000. Recovery from insurance relative to the loss was 2 million. The question now is how much shall be deductible as loss? The answer is the construction cost of 4 million, add improvements of 1,500,000, the total amount is 5,500,000. Less the accumulated depreciation of 2,500,000, we have a book value of 3,500,000. So kung walang insurance to, yung buong 3 million is the fire loss. But since merong insurance recovery of 2 million, that is binayaran ng insurance, so meron ka na lang deductible loss na 1 million. Sa accounting, meron tayong tinatawag na receivables. There is bad debts because of the result of the worthlessness or uncollectibility of the receivables. So before a taxpayer may charge off and deduct a debt, he must ascertain and be able to demonstrate with reasonable degree of certainty the uncollectibility of the debt. The determination of worthlessness in a given case must depend upon the particular facts and the circumstances of the case. Bad debts to be deductible, there must be an existing indebtedness due the taxpayer which must be valid and legally demandable. The same amount must be connected with the taxpayer's trade, business, or practice of profession. The same must not be sustained in a transaction entered into between related parties. The same must be actually charged off the books of accounts of the taxpayer as of the end of the taxable year. And the same must be actually ascertained to be worthless and uncollectible as of the end of the year. Let us assume that in 2019, a taxpayer estimated that 140,000 of its accounts receivable was uncollectible. In 2020, 90,000 of these accounts was ascertained to be worthless and a write-off has been effected. Related entries in the books are shown. In 2019, debit bad debt expense, 140,000, and credit allowance for bad debts, same amount, 140,000. In 2020, allowance for bad debts, 90,000, and credit of accounts receivable, 90,000. This is to write off the worthless accounts. Please take note that the taxpayer cannot claim for bad debts as deduction from gross income in 2019 when the estimated was set up. It is only in 2020 that the claim portion of the accounts receivable or 90,000, which was ascertained to be worthless and which was actually written off the books.